of ET Markets Money Talk right here on ET Markets live stream, your own destination to get all wealth related news and be a part of discussions that matter. My name is Deepika Dhanda Singh, and today we have with us a very special guest, Mr. Sumit Chanda, founder and CEO of Jarvis Invest. Today we will talk about why does emotionless investing help investors in stock investing, and how does artificial intelligence can handle your emotions. This is in continuation of our series on demystifying artificial intelligence investing. And to chat with us on it, I welcome Mr. Sumit Chanda.
Thank you so much, Ritika.
Thank you for being a part of the show, Sumit. To begin with, let me ask you, how do emotions determine the performance of an investor's stock portfolio? Is emotionless investing better for the health of one's financial portfolio?
Of course, yes, because when it comes to equity investments, a lot of the decisions, and especially the buying and selling decisions, are driven by emotions and not by any logic or not by any rational, and that is actually harmful for the health of the portfolio and the returns of the portfolio. Now, a lot of people don't realize this because you know. Uh, uh, a lot many times depending upon the market and the volatility in the markets and volatility in certain stocks and the sentiments out there in the market, people sometimes take the wrong calls, and there are various reasons. I mean, we can probably talk about it as we move ahead. How emotions are affecting, but yes, emotionless investing or emotionless portfolio management should be the right way or right approach towards managing one's equity portfolio. Unfortunately, that generally doesn't happen. A lot of behavioral and emotional biases plays around in the mind of people while they're dealing with the stock in the buying and selling decisions.
All right. What are the different types of emotions that an investor needs to deal with in the stock market?
Uh, well, just to avoid some of the jargons in terms of the emotional biases, I would rather answer this question with few examples. So, what happens is when somebody is investing into a certain set of stocks, then many types of emotions plays around. So, for example, I would have made money in a particular stock 5 years back, and I have a very positive emotion towards that stock. Now, irrespective whether the stock was doing well 5 years back, whether it is still doing good now, fundamentally, I don't care. But I just have an affiliation towards that particular stock, and I am bullish on that stock. So these things happen. Similarly, it happens that just to give you an example, if I was working with HDFC Bank over 10 years, and I have a very very positive attitude towards that. I love that company where I worked for 10 years. So irrespective of whatsoever happens out in the market, I will always think positive towards it and always be bullish on that particular stock. Like HDFC is just an example; it can be any other listed company. But when it comes to the company's performance, it does not always go north. So there are always volatilities involved in that. But somewhere I ignore all of those things and I say that no, this stock is always good. Then third, I would point out, there are certain cases when the markets are highly volatile. Uh, while the investors invest from a long-term perspective, I mean, while investing, they would think that, okay, I will stay invested for the next 4 years, 5 years, 10 years. But whenever there is a market volatility, like consider COVID, March 2020, when the market corrected by 33%, most of the stocks corrected by as high as 50, 60% also. Now, if you are a long-term investor, you should absolutely not get impacted because whatever goes down will come up. But there's a lot of panic selling happening in those scenarios, and that was an outlier situation where the market corrected by 30%, 30 plus percent. But even in smaller corrections, we have seen that even if the benchmark corrects by about 8% or 10% and stocks correct by about 10 to 12%, people panic, people do sell, and at that point of time they don't realize that, okay, what's my objective of this investment? It's actually long term. So similarly there are many other, I can keep talking about it in terms of how emotions and behavioral biases plays around in the mind of people.
So, in fact, well said. Now, before we sort of go ahead, I'd request each and everyone who's watching the stream right now just say hi, wave at us, and if you have any questions, do let us know. We'll take them up with Sumit. Now, let me move on to my next question. In the stock market, what does an individual require more, Sumit? Discipline or skill to stay invested for long?
I think from a long-term investments perspective, it is discipline that is required. Uh, Skill, I would say, is required for trading, not for investing. For investing, identifying the right set of stocks where you want to bank upon over the over the next 5, 10 years, or whatever is the horizon, that part would be a skill. But then that's not that difficult. But having said that, staying through through the market cycles, irrespective of whatever happens, irrespective of whether there's a black swan event happening. But if I have my horizon correct, if I know that, yeah, I need this money only after 10, 15 years, or I don't want to touch this money after, for the next 15, 20 years, I should actually not do it. Having said that, uh, one should always have keep a tab on the investment. So I have come across a lot of investors and clients who say that, yeah, they are long term investors, and yeah, they are true to their words. They do not actually touch their portfolios, but in that process they also do not look at the portfolio at all. And I have come across customers who have about 100, 150 stock portfolios, and in their life they have never sold a single stock, and only after, say, 15 or 20 years down the line, they realize that 20, 30 of them have got delisted. They don't they don't exist anymore. So I am saying, so from that perspective, having a disciplined approach is good, but you should also have a tab in terms of, if something is going wrong, if in one of your stock, so fundamentally wrong that you can lose a lot of your money invested in that stock. So that has to be tracked.
All right, we know that short term volatility is inevitable in the stock market, right? So, what is the role of emotions in such scenarios?
uh, I think this would be in continuation to the second question that you asked me, the types of emotion that plays around in people's mind. So on that, typically what happens is, uh, we look at, say, we are trading through a mobile app, we look at the values every single day. And fortunately, unfortunately, we always want to be in green there. But in market, it always does not happen. So you see reds also. And typically, when you see a downtrend, the downtrend continues for a slightly longer term. And, and sometimes people do panic because of that. They start questioning whether they invested in the right stock or not, whether they want to be in that stock while it is going through that entire downtrend. Now, what happens is, there are many emotions playing here. One is that I would have exited before it would have recovered. So that happens many a times. A stock, where I invested at 100 rupee would have gone to, say, 80 rupees, and I think that, okay, now it will go to 50 rupees or 60 rupees, and I exit, and the next week I see that it has recovered back to 100. So that happens because lack of study, I would say, lack of understanding, and majorly emotions playing. So when we see a dark red on the portfolio, we do not look at any study. We simply think that, okay, let me preserve this money, whatever is left. On the other side, also, we have seen that sometimes if a stock has performed well, so I bought something at 100, it has gone to, say, 140, and I feel that, okay, that's enough for me. I have gained 40% returns in such a short term. I should exit. But you don't, probably you did not know that the rally was supposed to go till 180 or 200. So
Yeah.
again, a different emotion plays out here, wherein I feel that I have already won, I've made returns, and let me exit out of it. So similarly, there can be many other things, many other scenarios that keeps on happening when it comes to emotions in buying and selling, the trading decisions, the investing decisions, and all.
Yeah, all right. Before we sort of go ahead with our conversation, I'd request all of you watching the stream right now, do hit the like button, follow Sumit on our page. Now, my next question to you is, Sumit, does goal based investing help to keep your emotions at bay?
Yes, to a lot of extent. So when somebody is able to define a goal, now goals are typically, let me clarify a bit. So goals are typically, it can be for one's retirement, wherein the horizon is defined that, say, if I'm 30, 35 today, and I want to retire at say 55, so I know that I have got a 20 years or 25 years horizon. Similarly, people would have certain goals in terms of their children's education, marriage of the children, buying a home, planning for a holiday. So now planning for a holiday and all these things becomes short term or a mid term goal, but typically an education, marriage, retirement, these becomes a long term goal. Now in all of these scenarios, many a time investors are very clear in terms of, okay, I don't want this money because it's for my retirement. So it becomes slightly easier to categorize these investments. So they can very well say that, okay, these are certain set of mutual fund or stocks which I don't want to touch for the next 20 years, so they go into my long term basket. This is this is a money which I would require for probably my emergency corpus. So I need the highest amount of liquidity, so I don't want to take a lot of risk in this money. Then probably I need this money to buy a new car or a new house in the next 5 years. So again, this becomes a slightly mid-term or a short-term kind of a goal. So the risk can be balanced. So if somebody is actually having that approach of a goal-based investing and sticks to it with a lot of discipline around it, then yes, they can practically overcome the emotional side of investing. But having said that, yes, a lot of discipline is required to do that, to achieve that.
Thanks for your insight on that. Now, connecting all the dots to artificial intelligence, I would like to ask you, how can artificial intelligence eliminate the element of emotions from investing in stock market?
That's interesting. So, see, when there's a human, there will be emotions. When there'll be human, there'll be behavioral biases. But when there's a machine, there's only logic and only rational. There's nothing else. There's no emotion that the machine has. It's only data, and it's the output of the data. That's what it is, nothing else. So from that perspective, what happens is, how does a human emotion comes when it comes to trading? So, you know, let's take an hypothetical scenario wherein the markets have slightly corrected. My stock has corrected by 15-20%, and I am in a panic situation. I don't know what to do with this stock. And I feel that, okay, let me preserve whatever money is left and let me exit. On the other side, as I also gave the previous example, that if I'm making money, I sometimes feel happy that, okay, I already made 30-40% returns, let me exit. I'm happy for this. I did not expect. I expected 15%, I got 40%. I'm more than happy, let me exit. Now, a machine would not think like that. Machine would actually look at a lot of data points around and take a decision. Now, on the other hand, a human investor, while I'm saying an emotional bias comes into play, this majorly comes from not having the complete study of the market. So if I would know in the first example when the markets, I said the stock would have corrected. If I would have known that, this is a temporary cycle, I have a long term horizon, I should stay back, it will come back, it will, go back to its own trajectory up north. Similarly, in the second example, if I feel that, okay, I have generated 40% returns, but let me study a bit, let me look more about the company, let me look at how well the overall fundamentally the company is doing, what are the people talking about it. So generally we don't do these things. When there's a when there's a panic, there's a panic. So I don't talk to people, we don't talk to people, and we just take a decision. But when it comes to the machine, it practically goes back, looks at all the fundamental data at that point of time, it looks at the technical information at that point of time, it would look at uh, you know uh, all the data points. Now these data points can be how the overall macroeconomy is supporting that particular stock or a sector, how people are thinking. So if I am panicking, are 1 lakh other investors in that stock are also panicking or not? So what's the advance decline ratio of that particular stock? Not today, but over the last few days or few weeks or few months. So a machine is able to look at all of these informations concurrently and process in a way to reach to a logical conclusion to that. And that's how it is able to overcome any emotional or behavioral biases that a human would otherwise have.
Yeah, true that. Now we have a lot of questions coming in from our viewers. Let's take them up, starting with Deepak. He wants to ask you, what are the factors on which AI works for the stocks to get in or get out?
So that these are the factors are the data points that an artificial intelligence machine would look at. These are typically the fundamental data, but the thing is, all of these data are in large volumes and large amount. So when I say fundamental data, it nearly looks at about 10 years of quarterly data, which is nearly 24 billion data points. Similarly, it would look at time series data of maybe the last 10, 15 years. That would be another few 10, 12 million data points. Then it would look at the compliance, the regulations for all the sectors, all the stocks. It would look at the corporate actions happening on a pretty much live basis for all the stocks. Then it would look at any news, events, activities happening around the globe, which would have a positive or a negative or a neutral impact for any of these stocks. So put together all of these information, these are what we call as data points. They are in way in millions, which humanly is not possible to understand. So machine consumes all of this information with the help of big data, and the artificial intelligence applies a lot of logic to it, and eventually it comes out with a solution and output.
I hope your query's been solved, Deepak. Now, coming to Rihan's query, he wants to know what is the best time for investing?
I think I have said it, before also. I think any time is good for investing. There is no good or bad timing. It absolutely depends upon what your objective of investment. So if you have time on your side, if you have horizon on your side, if you're looking that, okay, I want to invest for the next 5 years, 10 years, and I believe in the market, then I think any time is good. It can be a down market today. It can be the topmost peak today. It is a good time to enter. Having said that, unless you have a very short term approach, so you want to invest only for the next 6 months, only for the next 1 year, then probably timing the market would be ideal. But honestly, it is very difficult to time the market because nobody can predict that where the market will be 1 year or 6 months down the line or 1 year down the line. So when it comes to equity markets, it is always better to have a long term view. And from that perspective, any time you can enter into the market, there is no good time or bad time.
So I hope your query has been solved, Rehan. Coming to Ravi's query, he wants to ask you, he has 5,000 shares of Delta Corp at 219. What to do as today's result day, but share is still not moving?
So that would become a very, stock specific advisory, and unfortunately, I won't be able to do that. But having said that, you can keep tracking the stock today, how it moves. You can look at some of the data points, how things are moved. So first of all, if it has its result, please have a look into that. Look into the advanced decline ratio, how people are reacting to that. You can check the technicals of that stock, and if you are a long term investor, then you can stay invested. That should not be a problem. But unless you have a short term investor and you want to exit from that particular stock, only then look at the technical charts and decide whether you want to stay or you want to exit. Otherwise, I think you can stay put through.
Samrat wants to know the best way to invest, whether in index investment through mutual fund or purchase directly from share market.
See, it absolutely depends upon how much knowledge and how much time you have for managing your investment. So, if you absolutely are, a new investor, or you don't have much of the knowledge about the markets, then an index investing would be ideal, wherein you don't have to think about much in terms of where to invest and what to exit and how much to invest and all. But if you have your investments already diversified into other buckets like an FD, something into mutual funds, maybe a bit into ULIPs in insurance, and a couple of other places, then you can look at direct equity investments also. The kind of returns the direct equity investments can give you, no other instrument can ever match. No, but then you have to identify the right set of stocks, and you have to stay through those stocks, through a particular cycle. So only then you will be able to have an edge over any index fund or any other investment product out in the market.
He probably wants to know the best way, passive or non passive in investment.
So I think if you are a novice investor, a first time investor, then maybe a passive investment should be good. But if you are an experienced investor, if you have done your investments in the past, if you know the market, understand the market, I think then active investment should be a good answer.
Thank you, Sumit, for solving all our viewers' queries. On that note, thank you so much for your time. Well, that's all for now, but do stay logged on to ET Markets live stream for more investment ideas.